Thank you for joining today's session. We will be getting started shortly. We do have a lot of folks signed up for today's session, and we want to give everyone a moment to log on and get connected so that we can dive into today's session. I do want to thank you all for joining us today. I'm Jasmine Garrett here with the New Jersey Economic Development Authority. Today's session is an informational overview on the agreed upon procedures report that will be required with the GROW EAO annual reporting. A quick housekeeping note, we do suspect that many questions will be answered in today's presentation. However, you are able to write in questions at any point during the presentation using Zoom's Q&A feature. It is one of your Zoom command options and will allow us to make sure we're able to get back to you and let others see these questions and answers as well. Today's session is being recorded and will also be posted on our NJEDA and YouTube pages. The slides and other resources will also be available in the next few days. Now, to get us started with the presentation, I will shift things over to NJEDA's Director of Incentives, Servicing, and Compliance, Kiera Black. Thank you.
Thank you, Jasmine. Good morning, everyone. Thank you all so much for joining us. We definitely appreciate how attentive everyone has been to these updates that we are having to the annual reporting piece for the GROW EOA project. If we could put the slides up, that would be very helpful so we can go ahead and get this started. Again, my name is Kiera Black. I am the director in the Tax Credit Compliance Department. We introduced to you all last month an overview regarding the changes that were going to occur with the annual reporting starting April of 2026. So the same panel is here today, myself, Kiera Black, and then my colleagues, Tanya Williams and Rich Dickinson are here as well. So we're here to provide the part one of our training. Again, last month, we did the general overview webinar that was introducing what was to come. In that webinar, we discussed the adopted amendments to the GROW regulations. So those GROW regulations pretty much were letting everyone know that the agreed upon procedures, which is the AUP report, is now going to be required for GROW EOA annual reporting. So we wanted to make everyone aware of that, give everyone the heads up. And the qualified CPA firms are those that will be able to provide that AUP report. So in order to become qualified, you must attend the webinar, have applied, put in an application, provided the EDA with your peer review report, and attend the three training sessions. And today is training one, which is the AUP guidance. Next slide, please. Again, introducing myself, Tanya and Rich. And just a few housekeeping things before we proceed with the actual training. This is a recorded session, so it will be available on the NJEDA YouTube page for future viewing if one was not able to attend this live session. Also, in this session, we are not taking live questions, so please put your questions in the Q&A feature. I slated this training for an hour and a half. We may not need the entire hour and a half, but I did want to give us some additional time. I know the AUP, guidance may evoke a lot of questions. So I wanted to make sure we had ample time to be able to go over questions that you all put in the Q&A. If we don't need the entire hour and a half, then we will just have some time back. But I, again, just wanted to make sure that we did have enough time slated. And again, if you do have questions, even outside of this training session that you didn't put in the Q&A box, that's okay too. You can put it in our portfolio services at njeda.gov box. So we have been seeing a lot more momentum in that box since we did our general overview webinar last month. And as everyone has seen, we have been responding and providing expeditiously responses to what you all have put in the box. So you can continue to use that box as well. So let's get into it. Let's talk about the AUP. So this training session is being held because we do understand that although all of the Grow EOA projects, when they initially were certifying project completion, there was an AUP report that needed to be submitted as one of the requirements for that overall certification. However, we did not require that for annual reporting until now. So everyone should be fairly familiar with what an AUP is because, again, you needed an AUP at time of overall certification. So we are now introducing that for the annual reporting side of the GROW reporting, the GROW EOA reporting. And we want to just ensure that everyone is comfortable, they are familiar, they understand what is needed in the AUP report. So we literally created this guidance to be able to provide everyone with clarity and a clear understanding of what EDA is expecting in the AUP report. And in addition to this training, we felt it was necessary to give additional guidance regarding, okay, how does the EDA go about reviewing annual reports and what are the processes that we have in place that could be very helpful when it's time for the methods and practices that the CPA firm decides to use when submitting the annual report. And then again, we felt it was necessary to do another training about inputting that all of that annual reporting required documentation into our portal. That is something that may be new to someone. They may not have had any actual experience with submitting into our portal. So we wanted to give that guidance as well. So we're trying to cover all the bases here. We're trying to make sure that everyone is feeling supported. Everyone knows what resources that they need in order to submit an annual report that has all of the requirements, including this AUP that is now required. Okay, next slide, please. So the AUP guidance. Everyone should have received an email this morning of the AUP guidance. This is actual guidance that you will use when you're starting to prepare your AUP report. Now, this is a fluid document. Once you've had time to really review this document, once you've had time to really start to register what is being asked of you to put inside of the AUP report, you may have questions. You may have feedback. You may have comments. And we welcome that. We want that. We want you to understand that this is a collaborative effort. We get it. This has not been required prior to now for annual reporting. So this is a work in progress. We feel like this is a really good start, but we are not naive and we understand that this may be just the first iteration. There may be versions that come after that. So the version that you have right now should say December 2025. And if there are some updates after we get some additional feedback from you all, you get your comments, your questions, and there's things that perhaps we can clarify better or that we can update, again, we welcome it. We want it. So we are just letting you know that this is a fluid document. Don't feel like this is something that we don't have any flexibility around. We want everyone to be successful with this. So again, we are willing to hear your feedback and work collaboratively with everyone so that we can get this running as a well-oiled machine. Again, this is, adopted amendments to the legislation. We are bound by what the legislation says, so we have to adhere to it. And we want everyone to feel supported while they are remaining compliant with these adopted amendments to legislation indicates. So the first part of that AUP guidance that you received, it talks about preparation. There are many, many documents that we are making sure that you are aware of that you need to gather when you're going to prepare the AUP report. Of course, the GROW statute and the GROW rules and regulations. That's something that you should just always have handy so that you can refer to, that you can be able to look up. It's going to be really hard to retain everything about GROW. I mean, we work with GROW day in and day out, and there's still things that we still have to look up and reference because it's just a very complex program that has a lot of information, and it's just impossible to retain it all in your head. So make sure you have the statute and the regulations handy to be able to reference in the event that you have questions about the program itself when you are preparing the AUP report. Okay. The other thing that you're definitely going to need is the agreement, what the company agreed to with the EDA. What is the agreement? What are the terms of that agreement? That executed document the company should be providing you with so that you can understand what are the specific terms that are not just the overall regulations, but what are the specific terms that this company is in agreement with the EDA. So make sure you get that incentive agreement so that you can have a familiarity and understanding of exactly what this company has agreed to and got in contract with the EDA. Okay. The next thing that you need is what we are referring to as the project completion certification. That's in essence when the company they submitted their final, what they did as the project, what their final project was. It's showing that it was completed. And then we here at the EDA, we analyze that. We determine, did they do what they were board approved to do? Did they meet the capital investment requirement? Did they meet the jobs component? Did they sign all the certifications as required? So when that project certified, saying we did everything, we finished, we are now ready to employ these jobs here at this specific qualified business facility, when they submitted that certification to us for review, and when we finalized our review, we sent them something saying, yes, your review is complete, you are in compliance, and here are the terms that you met. Here's what you earned through this project completion. There is some projects prior, maybe from the earlier days, that may not have this finalized review email. If the company that you're working with is advising they just simply can't find this finalized review of their project completion, that's okay too. You can feel free to reach out to the assigned officer and let the officer know. The company is not able to provide us with that. Are you able to furnish us with the project completion certificate? That's no problem. We will be able to help you out with that. Again, we are trying to be a resource for you all. So we're working with you all. So the assigned officer on that project, if the company isn't able to furnish you with that project completion certificate, just reach out to the officer and we'll be able to provide next steps, okay? But you need that because it specifies what they actually earned. Now, board approval was saying, here's what we are expecting you to do. This is what the board approved you to do to complete this project and qualify for this incentive. Well, sometimes when the project completion is actually submitted, they may not have actually met everything that the board said that they were approved for. It may have had some differences. And if that is the case, they did not earn the full award amount that the board approved them for because there may have been some adjustments due to if they didn't actually complete it exactly as it was board approved. So you're going to need that project completion information because you need to know the incentive agreement may say they were approved for X jobs, but when they submitted their project certification, it might have only been Y jobs. And that's the maximum that they're going to ever be able to earn through this incentive. So you need to know that information. You'll also need the annual report reminder. Every year, as a courtesy, the Tax Credit Compliance Department sends out an annual report reminder. We don't want anyone to miss the deadline to submit their annual report. So we literally are sending everyone a reminder saying, okay, it's about that time. You need to start making sure you're submitting within that 120-day deadline. Again, we are bound by what legislation indicates. Legislation says that their annual certification needs to come in 120 days from their tax filing period end date. That's what we're bound by. If they don't submit it by the 120-day deadline, they will be forfeit. They're not going to receive a tax credit incentive for that tax period. We don't want that. We want everyone to be successful in this program. So as a courtesy, we send out these reminders. And in the reminder, there is a list of everything that is needed to submit a complete package. All the required documents, as well as all the supplemental documents that are needed for us to complete an analysis. That reminder email is going to be a wealth of knowledge when it's time to prepare this AUP report, because you now have exactly what the EDA is looking for this annual report submission. So when it's time to submit things into the NextGen portal, you know exactly what should be submitted in that portal in addition to the AUP report. Also, we are advising to get payroll documentation. A part of annual reporting is, yes, the jobs. That's the big component that's driving what the incentive award calculation is going to ultimately be. You're not able to substantiate jobs without some level of payroll reporting. So get some, whatever methods that you all utilize from the HR department, whatever their payroll department uses, get that documentation so that you can substantiate those jobs that the company indicates on the job log. Just because they put it on the job log does not mean that it is actually something that is in compliance and can be used as an eligible job to be incented. So every job has to be checked. There is no just, I'm just going to do a little sample, I'm going to do a little pool of these. Every job has to be checked. So you need to be able to corroborate that job that's on the log versus the payroll reporting that the HR department has. The job report itself, that log, it's going to come from the company. The company is going to furnish the qualified CPA firm with the annual job log. It's going to list who they believe are eligible jobs that can be calculated in the incentive award. Again, just because it's listed doesn't translate to that it is actually in compliance. So the CPA's job is to use that log compared to what the HR payroll documents say to substantiate, is it actually in compliance, in addition to all the other questions that's on the log. The job log is very intensive with what is required and what can be deemed eligible. So that job log from the company is going to be needed as well. In addition to if there are any board approved affiliates, those affiliates that are approved to be a party to the GROW, there may be documentation that needs to be obtained from them as well. So make sure that you understand who the approved affiliates are. And those affiliates that are able to be listed on the job log as employing entities, making sure that you are cognizant of exactly who those entities are that are allowed to be party to this grow, so that you can get any necessary documentation from those companies as well. In addition to the qualified business facility itself, which is a key factor for this grow incentive. The QBF, which is the abbreviated name that we use, is key. If the company was approved for a specific address, specific square footage, specific usage of that square footage, all of that has to be confirmed that it is indeed what was board approved. So you're going to need the floor plan. You're going to need to understand what is the actual facility that these jobs are housed in. You're going to need that specific information. And then any other HR related documentation, again, it's not just limited to payroll documentation, but things that you are going to need to corroborate that they worked as full-time employees, that they received health benefits. So all the things that are required as a compliance piece to be an eligible job, all of that is going to need to be obtained so that your methods can be noted in the AUP that it is confirmed that that particular job is indeed eligible. And then the last thing that you're going to need for preparation is access to the portal. You have to submit all of this. You have to be able to get into the portal. So you're going to need authorization from the company to do that. So you're going to have to get their buy-in, get their green light to give you authorization to be able to get into the portal. Right? So that is one of the easiest ways to help yourself to be successful with preparing this AUP is that preparation piece. Make sure that you use this guidance to really get yourself in a position where you have all the pieces of the puzzle that you need so that when it's time to start really preparing the AUP, you can get to that. All righty. The next component is the job log itself, as we talked about. The job log is going to come from the company. The company is going to let you know, here are the people that work in this work in this QBF that we believe are eligible. You then have to do your due diligence to confirm that eligibility. And you have to make a decision on accept or reject for each job on that log. So again, it's no sampling, it's no pooling, it's just I'm going to look at each job and I'm making a decision on accept or reject. We will discuss that further in this training. The next thing about the AUP is the job count and the median salary. Those are things that you are expected to come up with a definitive conclusion. What is the average job count and what is the median salary? You are expected in the AUP to indicate that definitive number for the job count and the definitive number for the median salary. And then as far as the job count, it's not just the count, you also have to classify those jobs. Jobs can take many different names. Maintain jobs, which were here in New Jersey before this project came to be. Retain jobs. And then there were new jobs. And then there's in excess if there are the average job count exceeds that total that is needed. But we'll get more into that. The other component is calculating withholdings. There are jobs that are the QBF is in a specific area of New Jersey, which is called a priority area. If that QBF is located in a priority area, then withholdings is going to come into play. You need to calculate that if the QBF is in a priority area. Statewide determination. That's a big one. We are not able to proceed if they don't meet at least 80% of what the board approved statewide number is, or as amended. 80%, that's the test that has to be done. It needs to be in the AUP. That number, definitive number, needs to be calculated and determined. Did they meet that 80% of what was board approved, or again, as amended? And if not, then that award is being forfeit for the year. They're not going to get it for that tax period if they don't meet at least 80%. So the statewide determination is really important. Bonus eligibility, another big one. Those bonuses, did they meet them? Are they eligible? Are they able to receive incent for the additional above the base award? Very important. So that needs to be determined. And those bonuses get tested. There are a multitude of bonuses, and there are a good percentage of them that get tested annually. But we'll go over that to determine which ones do get tested annually and which ones don't. And then the certifications themselves. We know that for these GROW projects, the CFO or the comparable position to the CFO, if a CFO position does not exist, that person needs to certify this project annually. So that means those certifications need to be signed by the CFO. That person is responsible for saying, yes, I certify this to be true and accurate. And there are about a dozen or so certifications that need to be submitted every annual reporting year. The CPA is going to be responsible to ensure that not only are the certifications completed correctly, but that they were executed correctly as well. So those are the components of the AUP report itself. Again, we'll go over each in more detail, but we just wanted to make sure that everybody is clear and understanding, and they can see it in this guidance that we provided, that these components must be a part of that AUP report when it is submitted with the annual reporting in the NextGen portal. All righty, next slide, please. All right, so we talked about the AUP preparation, the document collection. Just to, again, touch base on a little bit more, the company really needs to make sure that they are providing you with the HR documentation with respect to payroll, on-site, remote attendance, health benefits. All of these things are going to be questions that need to get answered so that you can determine, is this a job I'm able to accept, or is this a job that I have to reject? So you need all that underlying information. You need all that documentation to be able to make that decision, because each job needs a decision. It's either going to be, I'm accepting this job as eligible, I'm rejecting this job, they don't meet all the criteria to be eligible, or it's to be determined. Because there might be some questions that you may have that the company can answer and provide the underlying documentation for to allow you to get to and accept. But only jobs that are accepted can be included in the average. And so you need to make sure that the documentation that you collect as the qualified CPA who is preparing the AUP and submitting the annual reporting is showing that this is in compliance and that you have the documentation to back that up in the event of any internal or external audits that may happen. So, it's really imperative that you, as the qualified CPA and the company's payroll department, are very in collaboration when it comes to submitting the AUP report, and that you have the underlying documentation that you need to be able to come to a conclusion about accepting or rejecting the jobs that the company indicated on the job log. Okay, next slide. Now, the job log itself. That was a perfect segue. The job log itself is intense, for a lack of a better word. It's very involved, because here in the tax credit compliance department, our number one job is to ensure compliance. And we are not going to allow a job to be included in the average job count if it has not been determined that that job is indeed compliant and eligible. So we have to go through a strenuous review to make sure that the job is able to be accepted. And once it's accepted, we have to make an average for all those accepted jobs for each month of the 12-month tax period. So it's not just a matter of accepting a job one time. It has to be accepted for each month. So you are indicating in the columns on the log, in January, am I able to accept this job? In February, am I able to accept this job? So on and so forth. And that's for each job on the log. Again, no sampling. So looking at the header, the column header, you're going to answer each question for each job for each month. If a job was eligible in January, that does not automatically mean it's going to be eligible for the other 11 months of the year. Perhaps that job terminated. Perhaps that job was not compliant in one of the other columns. So again, it's really important that you are verifying each job for each month on the log. And you are making a determination of accept or reject for each job for each month. Each month, once you get your total of accepts, you're then going to come up with, all right, I have my total for all 12 months. Now I can take an average because now I know what's accepted. I know what that count is for each month. Now I can do an average of the 12 months to get to my total number to see what is my average job count for this tax year. The 80% test, it must be met every year. When this job certified, as we discussed earlier, when they said, okay, we're done, we've completed everything that the board told us that we were approved for, we've completed it, we're submitting our project certification. At that time of overall certification, that job count was determined what they were certified as their average job count. Again, it could match exactly what the board approved, or it could have come in a little less, which again now changes their award calculation. You're now looking at that project completion certification information that we talked about earlier. You're seeing what did this job count come in as at time of certification. So now that we're at annual reporting, you're wanting to make sure that the annual reporting count is at least 80% of what they certified. If it is not at least 80% of what they certified at overall certification, then they will be forfeit. They are not allowed to go below 80%. When they signed up for this program, they said that they would meet a certain job count, they would meet a certain median salary, and we are holding them to that. They must be compliant. But we understand there's flexibility. Things happen. There may be some level of fluctuation in the workforce. We get it. That's why we're not saying you have to meet 100% of what you certify. We're saying you have to meet 80% of what you certify. And if that 80% test is not met once you've calculated the average, this will not qualify to receive an incentive. It's not eligible for this tax period. All righty. So first step, you're determining, am I accepting? Am I rejecting? What am I doing with each job for each month? Second step, I'm calculating the total that I have accepted for each of the 12 months in the tax period. And please keep in mind, the 12 months of the tax period does not mean January to December for all projects. The lion's share of projects, yes, is January to December, but some of them, they may have a non-calendar year tax filing period. It does not necessarily mean that it's going to be January to December. So whatever that 12-month period is, that's what you are looking at. And you're determining what is my count for each of the months of that 12-month period. After I come up with my count for each of the 12 months of that tax period, now I'm taking an average of those. That average, I'm now going to look at what was it at time of certification? What was the job count at time of certification? I'm going to compare that to what I now have just calculated with this annual report. Is this annual report count meeting at least 80% of what they certified? If so, great. Move on to the next step, which is classify the jobs. You have to determine where these jobs are going to go. Maintain jobs. Again, these are jobs that do not get incentive. They are not a part of the ability to be in the award. So maintain jobs are actually going to be rejected jobs on the job log. You are not going to accept those on the job log. They're going to be rejected because they're not eligible for incentive. But they have to be accounted for because the company agreed that they would maintain those jobs outside of receiving an incentive. So we're holding them to that. They said they were going to maintain X jobs. That means every annual reporting year, when they submit their log and we determine all of these jobs are acceptable jobs, they're eligible jobs, right off the top, those maintains that it was once an accepted job, it becomes rejected because we know we have to account for maintained. The next category is retained. Those are jobs that do receive an incentive award, but they are not able to be accounted for until the maintained jobs are accounted for. So the order that you are looking at all your accepted jobs is once you get the average, you're going to look at maintained, you're going to look at retained, and then anything left over can be classified as new. If you still have some left over after the new, then you can now have an excess. And in excess do not get incentive either. So maintained, in excess, they do not get incentive. Retained and new, they do get incentive. Please remember that new jobs will never, ever, ever be counted before retained jobs are accounted for. You will never incent a new job before all of your retained jobs are accounted for. So if that means that after you've accounted for all your retained jobs and there's not a lot left over for new, so be it. They're not going to receive the award amount per job for that new job until all retained jobs have been accounted for. So please keep that in mind. So when you get the job log from the company, it's going to, again, have all of the columns. They need an answer. The salaries are going to be there. You're going to get the job log from the company. That job log needs to remain unaltered. Don't tamper with the job log that the company gave you. What you're going to do is you're going to get another template from the EDA. That is going to be the template that you work from so that you can come up with your calculation of what are my totals per month of accepted job, what are I'm taking off the top for maintain, what average am I coming up with. You're going to do all your work on this other job log that the EDA is going to furnish you with so that you can do all your math, show all your work on this job log. The job log that the company gave you, do not alter it. This is just your data. This is what you are using to come up with your totals as you do your due diligence, but you're not changing anything that the company gave you. You're going to use that data to go to this sample job log that the template that the EDA gave you, and that's where you're going to do all your work. That's where you're going to do all your math. And you're going to come up with your average, and you're going to come up with your maintained, retained, new, and in excess. Okay? All right, next slide. Withholdings. So we talked about that a little earlier. I touched on it. Withholdings apply to projects that were approved in priority areas. So what you're going to do is you're going to look at that approval letter that we talked about earlier. You're going to see, where did this QBF, Qualified Business Facility, where did this QBF, where is it located? And if that approval letter says it is in a priority area, that means you have to calculate withholdings. And there's a tab on the job log that is going to help you get to your total withholdings. So we've created that as a part of the job log, where you're going to, again, the company's going to provide the information. You're going to confirm all of this information, because remember, you and their payroll department, you're working collaboratively. So you're going to use the payroll information from the company's payroll department to determine that these withholdings that the company provided, is all of this correct? Is this all quality? Is this information that I have here good intel for me to be able to come up with the withholdings? Am I following this template that's a part of the job log? It's really important in priority areas that you correctly calculate the withholdings, because there's another test. There's the 90% test in this case. You have to make sure that whatever those withholdings are, that the award amount itself cannot be greater than 90% of the withholdings. So in essence, the award is going to be the lesser of the two. So when the EDA is reviewing the annual report that you all submitted, that included this AUP that you're working on, and you're going to indicate in the AUP what the 90% of the withholdings are. When the EDA is going to, calculate the actual award, we're going to look at the AUP and say, okay, well, what was the 90% of withholdings? What's this award that our due diligence has unveiled is the actual award amount? We're looking at them to see, well, what's the lesser of the two? Because priority area projects, you are not going to receive an award that is higher than 90% of the withholdings. Okay? So this part is very important. So please get acclimated with it, calculating the awards, making sure that it is indicated in the AUP and the methods that you use to come up with that withholdings total, right? Next slide, please. Statewide tests. All right, so we talked about this earlier as well. Statewide tests, another 80% test. If they don't meet 80% of what was board approved, or again, as amended, then they just do not qualify. They're not eligible for an incentive that tax period. So the 80% test needs to confirm that all the jobs in New Jersey that are employed by this particular company are meeting what they said they were going to do at time of board approval, or again, as amended, because sometimes there have been some updates to the statewide number. You're just confirming that the information the company gave you, because again, the company's going to furnish you with their required documents, which one of them is this statewide analysis. They're going to indicate every month what their statewide was. What is that statewide number? And then you're going to come up with what that average number is for that full 12-month tax period. You're going to confirm, doing your due diligence, what the statewide number that the company gave you. And when I say the company, I'm talking about the CFO. Remember, certifications need to come from the CFO or a comparable officer in the company to the CFO if the company doesn't have a CFO. So when the company CFO gives you the statewide analysis, you're going to determine, is this from, again, your due diligence, whatever methods that you all use, is this aligning with what I have concluded is the statewide number. There is a component you do need to remember about statewide. Projects that were board approved after October 2016. Side note, how do you know when a project was approved? Look at the approval letter. Remember those documents that we said you should collect at the beginning? Go back to that, look at the approval letter and see, all righty, when was this board approved? Because that's going to help you understand how to calculate your statewide. So projects that were approved after October 2016, when you came up with your certified job count for the job count that you concluded when we bucketed in that last slide, you have to remember that for those projects approved after board October 2016, you have to exclude those new jobs from that statewide number. Now, again, we get it. It might not be as easy to understand the formula for this statewide test. And that's why we are going to be a resource for you. We're going to be available. You're going to have access to us. We want you all to be successful with this. And we get it. It might not be so black and white and easy to understand. Trust us. It took us some time to understand too. Figuring out the legislation, lawmakers write these laws and the legislation, and then they give it to us to implement. We have to figure out how to implement this too. So we have to come up with an understanding of it, and we have to help our staff to make sure that they understand it as well. Because again, the name of the game is compliance. That's what we do. We are tax credit compliance. That is our job. So we are not going to over-incent or under-incent. We are going to make sure that you are compliant for what you have actually earned. So again, if the statewide test is very perplexing or a little confusing, we get it. We understand. You are going to be able to access us to help you throughout, to help you understand, to make sure that you are you have clarity about this. You are going to go to the board memo to understand what was board approved statewide for this project. And then you are going to test against that to understand, did they meet the 80% or not? Once you have calculated the average job count from the job log that was provided from the company and your due diligence, your methods that you put in place, your collaboration with their payroll department to determine what that average job count was and that statewide count was. And once that number is determined, is it meeting 80% of what that job count, that statewide count was in the board memo? So again, don't feel frazzled about it. We get it. There may be a lot of this that you are having questions about. Feel free to put them in the chat. We're going to try, again, if time permits, we're going to try to hit questions that you all enter into the chat. And even if it doesn't, as we did with our webinar, our general overview webinar last month, we sent out that Q&A grid. Again, we want you to be successful. We want you to know that we're here. We want you to understand that we're working with you. So we are in this with you. We're together. So 80% test for statewide is extremely important. It can make or break if a tax credit incentive is going to be eligible for that tax period. So we want to make sure that you are understanding it properly. You have to do your average. You have to, again, if it's board approved after October 2016, you have to exclude the certified new jobs from that. And then that is what you're going to test against for your 80% test. Okay? Okay. Next slide, please. Bonus review. So as I mentioned earlier, there are many bonuses that may be applicable to the project that you are working on. Most all projects have some level of a bonus. There may be some where maybe it doesn't have a bonus. That could exist. Again, most projects do have some level of a bonus associated with them. So you need to understand what those bonuses do to impact the award calculation. There are a handful of bonuses that do need to be substantiated annually. So you need to provide the underlying methods in your AUP report that's evidencing how you concluded that they are indeed eligible to receive this bonus for this annual reporting tax period. So targeted industry, that's a bonus that is in essence saying that there are several industries that the EDA are able to give additional bonus for annually if that company, if their jobs are within those specific targeted industries. Again, we have 2 more trainings after this. The next training class is going to go in depth about the bonuses that are applicable, same with the job log. So it's going to be very detailed, the next training that we're going to have, which is on Wednesday, 2 days from today. It's going to discuss what those targeted industries are and how the EDA goes about determining, is it something that the company has met? Did they indeed earn this bonus for this tax filing period? Another one is large number of jobs. That one is a determination that needs to be made every year if they have earned it or not, and if it can be included in their award calculation. Median salary. That's why it's so important that the median salary is calculated with that job log that we talked about a few slides ago. The job log is going to have a column for the median salary to be reflected. And for every job, for every month, it needs to have the median salary associated to that job for that month. Because remember, a job might be eligible in January, but it might not be eligible in May. So you're not going to count that median salary for a month that they're not eligible. So every job for every month needs to have the corresponding median salary so that we can determine, is this median salary bonus being met? Same thing for our industrial premise bonus. That needs to make a determination needs to be made. The industrial premise bonus comes into play if the qualified business facility, the QBF, is at least 51% industrial. That means you need to have the floor plan. You need to understand what the uses are in that QBF. If you receive a floor plan that shows that the QBF is all office space, let's just say, then how could they possibly qualify for a bonus for industrial premise? It's not an industrial premise, it's office space. So you need to have the information to be able to make that determination. You need to show the math. How did you calculate that this is 51%? In the training that we are going to have on Wednesday, we're going to show you what the EDA does to determine, did the 51%, is that test being met? Did this company's QBF get utilized as an industrial premise at least 51% of this square footage? That means we have to know what the actual areas are in that QBF, what the uses are for each area, and what the square footage is for each area. And then we're going to take a comparison. Total up all of the spaces that are industrial, total up all the spaces that are non-industrial, and we're going to see which one is how much percentage for industrial, how much of a percentage for non-industrial. And if industrial comes up where it's less than 51%, they have not earned that bonus and it will not be included in the per person award. That is the expectation that the qualified CPA will do and will indicate in the AUP report what the methods were that were utilized for them to determine if the 51% was met or not. Solar energy, another one, where annually, if an award was granted with this bonus, we have to make a determination. Is the solar energy that is being utilized meeting at least 50% of what the energy use was prior to the board approval? So it's a lot involved in that. You have to understand. But again, we're here. We're going to be here to help you understand what needs to happen in order to evidence that they indeed earned this bonus. You may see other bonuses on the approval letter and in the project completion certificate that don't need to be verified annually. And those are listed here: the LEED Silver, the Poverty Pocket, Transit-Oriented Development, and the 2007 Revitalization Index. So those are just, again, something that it carries over year to year. We don't need to evidence them. They're just going to get them as a part of their award calculation. But the ones listed above, every year, annually, your AUP is going to need to confirm that they indeed earned it. Because again, tax credit compliance, our job is to ensure compliance and to not over-incent or under-incent. We're going to give them the incentive that they have actually earned. Okay, next slide. All righty, so as I mentioned, when I say company, I'm referring to the CFO needs to certify. There are several certifications that this qualified CPA firm needs to review and confirm. Was it complete? Was it properly executed? Did the information indicated on it, does it make sense? Is it something that is showing that they have actually understood what the certification is asking for and they completed it accurately and that it got executed by the proper person? Again, the CFO is responsible for certifying annual reports. If there is no CFO, they need to complete a certification that says there is no CFO and indicate in that certification who the comparable person is to the CFO at the QBF. So all the certifications you see here, you're going to make sure that that's a part of the package that gets submitted to you as the qualified CPA, because you as the qualified CPA will be uploading this package into our portal, the Next Gen portal, which is training number 3, which is going to happen on Friday. We're going to show you what you should be expected to see when you get into the portal and how to submit an annual report. These documents need to be completed accurately and properly executed so that it can be uploaded to the portal within that 120-day deadline. Again, we don't want anyone to miss that. We don't want anyone to not get a tax credit incentive simply because they didn't put what needs to be put into the portal by the deadline. It's very important that everyone remembers that deadline, 120 days after the tax filing period end date. And we, again, remember, as we discussed earlier, that does not mean that it's always 12/31. It could be a non-calendar filer. So it's very important to understand what the 12-month tax period is. And then once you know what that tax period is, you know from there, 120 days, everything needs to be in the portal. You need to get a confirmation number. When you submit everything into the portal properly, you're going to get a confirmation number that it's been submitted. So all of these certifications listed here, in addition to the AUP report that the qualified CPA is going to complete, in addition to the job log, all of that is going to need to be in the portal 120 days from when the tax filing period has ended. One thing I want to make sure I point out is this valid tax clearance certificate. It's really easy to kind of get confused with that. The tax clearance certificate needs to show NJEDA as the entity that you're getting the tax clearance for. It also needs to have 3 zeros, 000 as the suffix after the EIN. Not 001, not 002, but 000. Make sure that you are cognizant of that. We don't want to have to kick back saying you didn't submit a complete package because you didn't have a tax clearance that was correct. Remember, it needs to be the name of the approved parties to the GROW. So that's our GROW grantee and any approved affiliates. And please keep this in mind as well. If the company changed their name, the tax clearance certificate is going to show the new name. But if EDA has not been made aware that there's a new name, that could be problems. You don't want that. So you're wanting to make sure that if the company changed the name, they submit a modification application that is letting the EDA know we changed names. Our documentation is now going to show a different name, particularly this tax clearance certificate is not going to come in with the old name anymore. And we now are requesting via this modification application to have our name updated for our GROW. And we're submitting the application, the modification fee as well, because there is a cost associated with when you are modifying your incentive agreement, and all of the necessary documentation that's going to be required when it comes to updating the modification agreement. The incentive agreement. So please keep that in mind as well. So there's a lot of moving parts. There's a lot of things that need to align. Our job as compliance is we're making sure all of it aligns. We're not going to give you a tax credit certificate in the old name if you change it to a new name, which now means that the tax credit certificate is going to be in a holding pattern because we have to now get it updated to show the correct name of the company now. So help us help you by making sure that if there was a name change, that the documentation and certifications that you all are submitting, if you're doing that in this new name, that you have given EDA that heads up, you have submitted a modification application, you have submitted the modification fee, you have submitted the required documents that are required with the modification application so that we can process that modification and that we can now get your incentive agreement amended. Remember, this is an agreement. This is a binding contract. There were signatures that were executed from the company and from the EDA. If it's being amended now, we have to get new signatures. We have to get it updated from the company and from the EDA. We can't do that if we don't have that heads up about all of that. And we don't want to hold up the tax credit certificate because of something like that. So please make sure that that is something that everyone is in the loop with, everyone is aware with, and all of the necessary steps are being taken to ensure that things go smoothly. And that is truly the reason why the adoptions to the amendments were put in place for the CPAs to get involved so that these annual reports can come in such a way that they are so thoroughly and the quality of them are so accurate that when we get them here at the EDA, that can help to expedite the process of us getting our due diligence completed so that we can submit the recommendation to our sister agency at the Division of Taxation. You have to understand, EDA is a conduit. We don't issue tax credit certificates. We don't have the ability to do that. Taxation does. But taxation isn't going to do that if they don't get a recommendation from us. The only way they're going to get a recommendation from us is if our due diligence unveils that you all are compliant. And we're not going to be able to do that if you don't position us to be able to do that. So the qualified CPA firms being introduced is going to help to expedite that, because the qualified CPA is going to ensure that this annual report that is submitted is so thoroughly completed, so accurately completed, is the quality of it is so there that when the EDA gets it, the due diligence that they have to complete is going to help move this along that much quicker. So that is indeed the goal with this. Okay? Next slide, please. So that in essence concludes our AUP training. Again, you have the AUP in your hands. Please review it. Go over it with a fine-tooth comb. Any questions you have, please put it in the portfolio services email box. We want your feedback. If we have to update the AUP guidance, we're not opposed to that. We want your feedback. So please review it. Make any kind of comments, feedback, suggestions, anything of that nature that you feel are applicable. And the questions that we have here in the chat, what time is it? It's about 11:40 now. So we do have a few minutes to go over the questions that are in the chat. So before we do that, I'm just going to explain that there is a post-attendance questionnaire. You see the QR code here. Please scan it. Please complete the questionnaire. The only way a CPA firm can become qualified is submitting the application, which we made available with the original general overview webinar that was conducted back in November. That application needed to be completed. And in addition to that application, the peer review report needed to be submitted. The peer review needs to be at least within the last 3 years. The application, the peer review report, and confirmation that all 3 training sessions have been attended. If we don't have all of those pieces to the puzzle, we are not able to deem you as qualified. So with this post-attendance questionnaire, please scan it, complete the questionnaire, answer the questions on it, and that's going to capture your attendance. That's going to ensure that we know that you attended the webinar. And if you're not able to attend the live webinar, we're putting these webinars on our NJEDA YouTube page. You can go through the webinar there, look at it in its entirety, look at the full webinar, and then at the end of the webinar, scan, complete this post-attendance questionnaire. That's how we're tracking if all of the components to become a qualified CPA have been met. Okay, so now let's go to the Q&A session. First question here, it says, please clarify on the statewide job count. If they were approved for retained new, will we only report on the retained in the statewide count? This is counter to what has been done in the past. So this question, I believe, is referring to the projects that were board approved after October 2016, which we have to net out. We call that net new. We're netting out the new jobs from the statewide average that was calculated. So when a project certified at time of project completion and they submitted the certification and a determination was made that the new jobs were X, the retained jobs were Y, we know what they have to meet every year as far as what their new job count is, as far as what their retained job count is. So every annual report, thereon after project completion, we know what that number is that they have to meet annually. They have to be X for new, Y for retained. When statewide is calculated for annual reporting, if the project was approved after October 2016, when that statewide average is calculated, we're going to reduce that statewide average that was calculated by the new jobs. not the retain, the new. So statewide includes every job, every full-time job, be it the qualified business facility, be it if they have another facility that's not a part of this incentive, but is still in the state of New Jersey. We want to know what are the jobs throughout the state, even if it's outside of the QBF. Once we get that average of the jobs, the full-time jobs that are in the state, if it was board approved after October 2016, the new jobs that were certified are going to be deduced from that average. Again, we get that statewide is a little complicated to understand. We will be here. You will have access to be able to unpack that with us as this AUP is being completed. So don't feel like you're left alone or you would be in the dark and you're not clear on how to do it. We will be here to help you do it. So again, if you still don't understand it after what I just explained, that's okay. We'll be here as you're preparing your AUP to help you understand how to calculate the statewide, okay? Regarding question above, the company has a single project site. Well, again, the statewide is whatever projects that sites they have throughout the state. They can have many. If there are an employing entity in New Jersey and that EIN is the GROW grantee, that's the project that we are board approved for here at the EDA to give them a tax credit incentive. If that EIN employs others throughout New Jersey in other facilities, those jobs still need to be accounted for as a part of the statewide, because we just want to know what they are employing in the state. So it's not just the project site, it's anything that's outside of this within New Jersey. Okay. Next question. When will the portal link be shared, and has the portal been updated for the 2025 section? So the portal access to get credentials for the portal, the company, our actual grantee, the GROW recipient, has to authorize that. We will give the credentials to access the Next Gen portal once the company gives us authorization to do so. And that will allow you to get access. So once you become qualified, once you are confirming that you have agreed to have your name listed as a CPA that is qualified and able to submit the GROW EOA annual reporting, if you get into engagement, if the company actually retains your services and you guys get an engagement letter, that the GROW company is going to let the EDA know, yes, this person can receive login credentials to get into the portal. Okay. Next question. Is there an AUP template that can be shared? Yes, the AUP guidance was shared. It actually went out this morning. If you didn't get it, that's okay. Just send us a message in the portfolio service at njeda.gov email box, and we will get you a copy of it. But yes, the guidance for the AUP was shared first thing this morning. If you don't have it, look in your junk box or your spam box or, you know, something to that effect. It may have gone there. If you still don't have it, that's fine. Just reach out to us and we will get you a copy of it. Okay. Next question. Is the NJEDA going to dictate what procedures need to be performed for specific criteria, or does the CPA firm make that determination? So we are going to advise you what the EDA does to corroborate that the information in the annual report is indeed eligible. That is training number 2. That's what's going to happen on Wednesday. That's what the EDA does. We are not going to dictate to the CPA that they have to do what the EDA does. In fact, they may unveil another method that might be more efficient or might have a better way of doing things than the EDA. We're going to share with you what we do to give you a heads up on this is a method that you might want to entertain doing. That does not say that we're dictating to you all that you have to do that. We're just letting you know that this is what we do in order for us to get comfortable so that in the event of any internal or external audits, we have what we can substantiate as to why we came up with the numbers that we came up with as far as job count, as far as median salary, as far as ward calculation, all of those things. We know what the methods are that we use. We're going to share those policies with you all on Wednesday. Yes, Wednesday's training. You do not have to do what we do. You might decide that's a great method. We're going to do that. Great. Thanks for sharing. Or you might say, hey, you know what? I think there's a better way we can do that that would still net us a result that ensures eligibility and compliance. And you can use that method as well, as long as it's noted in your AUP and the underlying methodologies are clear so that, and again, in the event of an internal or external audit, you're audit ready. You're able to evidence how you came to the conclusion that you did. Okay? Next question. When will the 2025 report be opened on the portal? It's not yet there today. And for that question, I am going to actually refer to my colleagues, Tanya and Rich. If either of you guys want to update everyone on when will the 2025 report be opened on the portal, is not there today.
Good morning, all. Rich Dickinson, Project Manager. The 2025 reports will be available on the portal January 2nd.
Hi, Rich. There's a little bit of a
We are in the process of creating all the 2025 reports, and we make this available, as I said, on January 2nd. So that's when they'll be available on the portal.
Right. There was a little bit of an echo in the beginning, Rich. If you could repeat what you said initially, that would be perfect.
That the 2025 reports will be available on the portal January 2nd.
January 2nd. Okay. Okay. So I believe that is everything in the Q&A feature. I think we addressed everything. Again, if you think of something outside of what we discussed here today, you have another question that pops up, feel free. Please send it to the box. As you all have noticed, we are manning the box daily. We get back to you pretty expeditiously. We want you all to be successful with this. We, again, this is our inaugural year of doing that. Yes, there's some flexibility. We're understanding that this is new and it's taking time for everyone to not only understand it, but to even, get CPA firms that are going to become qualified and therefore available for our grow companies to retain. So we get all of that. We understand all of that. We are understanding that this is a process. This is new to you all, and us doing annual reports using AUP is new to us as well. So we're all in this together. We thank you guys for your participation thus far. We want to be as informative as we possibly can with this change. And we, again, want everyone to be successful with it, because the end goal is, we want those quality reports submitted so that the due diligence, when we receive it, we won't have to have it for the extended periods of time. And ultimately, we can get you all, the companies, the grow companies, the tax credits a little bit more expeditiously. Okay? So that is all that I have for right now. We will see you all again in 2 days on Wednesday to go over the NJEDA policies and how, again, we do things to ensure eligibility and compliance. And thank you again for attending. See you in a couple of days. Goodbye.